Okay, let's just dive right in. We are going to swap that nagging financial anxiety for a rock-solid and honestly surprisingly simple blueprint for wealth. Living in America today means you've got access to some truly incredible financial markets. But let's be real, with endless choices comes massive confusion, right? So today we're going to cut through all that noise. We're going to simplify the whole shebang into a clear framework for building wealth slowly, consistently, and intelligently. Picture this. You've got two people. Both are exactly 30 years old. Both are pulling in exactly $70,000 a year. But fast forward a few decades, and their futures look vastly different. Why? Well, it's not because of their income. It's because one relied on frantic spending, constantly upgrading the car, dragging around high-interest credit card debt, and waiting until they hit 45 to even think about investing. The other? They built the methodical system. They set up an emergency fund, maximized their employer matches, diversified, and then just let their money compound for decades. It's wild, but 30 years down the line, the difference in their financial lives is absolutely staggering, all because one person just had a better system. To demystify exactly how this works, we're going to walk through this practical roadmap step by step. First, building your financial foundation. Second, maximizing tax-advantaged accounts. Third, constructing your core portfolio. And fourth, automating your wealth system.
All right, phase one, building your financial foundation, which is all about establishing stability. Look, you absolutely cannot construct a skyscraper on a weak foundation. It just doesn't work. Before you even ask what hot stock to buy, you've got to pour your concrete. That means funding an emergency reserve, ruthlessly eliminating high-interest debt, and protecting yourself against major financial risks. Seriously, trying to out-invest a 24% credit card interest rate is a losing battle every single time. Investing has to begin with stability. Moving right along to phase two, maximizing tax-advantaged accounts, where we utilize some key structural tools. With the ground secure, we can start framing the core of our structure. And for so many working Americans, the employer-sponsored 401k is just a remarkably powerful compounding tool. Depending on your specific account, your contributions get valuable tax treatment and can just sit there, compounding for decades. But the absolute biggest advantage? The employer match. Listen, if your company offers to match a portion of your contributions and you don't put in enough to get it, you are literally leaving part of your compensation package behind on the table. It's essentially free money. And when we look at individual retirement accounts, or IRAs, it really comes down to a structural choice. Do you take the upfront tax advantage of a traditional IRA, or do you aim for those sweet, tax-free withdrawals later in life with a Roth IRA? The key takeaway here is that it's not just about what you invest in, it's about where you hold it. Managing your taxes through these specific structural tools is a massive game changer that can significantly accelerate your long-term wealth.
Now for phase three, constructing your core portfolio, which means selecting the right materials.
So, the framework is up, and it's time to choose our building materials. You probably already know how index funds work. They spread your risk across hundreds, sometimes thousands of businesses. Look, trying to identify tomorrow's single biggest winner is incredibly tough. So, instead of betting the whole house on one company, you just buy the entire neighborhood. That way, if one specific company struggles, your entire financial future doesn't come crashing down with it. Now sure, it might not make you look like a Wall Street genius at your next dinner party, but for long-term investors, boring is incredibly powerful. I love this old saying, your diversified investments are the foundation, your individual stock ideas are optional rooms. It really hits the nail on the head. Never build your entire house on one risky ticker symbol you saw trending online. Keep those individual single stocks as small, optional additions and let broadly diversified ETFs do the heavy lifting for you. Individual stocks are really only for investors who intimately understand the business, can stomach wild volatility, and fully accept the risk of having all their eggs in one basket. A balanced portfolio isn't just some random assortment of materials thrown together. While stocks usually get all the spotlight, blending in things like bonds can really temper volatility and potentially provide a steady income. And you've got to tailor this mix to your specific life. A 25-year-old investing for a retirement that's decades away is going to approach this mix very differently than someone who plans to retire next year. Your investment strategy should directly match your timeline and your own personal ability to tolerate losses.
Oh, and a quick word on real estate. Yes, we all know it's a historic wealth builder. But beware the dangerous assumption that property just always goes up. Buying a home carries some heavy hidden costs. We're talking mortgage interest, property taxes, insurance, maintenance, transaction fees, not to mention immense concentration risk. It's an absolutely powerful asset when the numbers make sense, but history teaches us a pretty harsh lesson here.
Property does not automatically just go up in a straight line.
Finally, we arrive at Phase 4, automating your wealth system, building the master system.
To ensure our structure lasts for generations, we need to look at the big picture. Over a 30 to 40-year horizon, your portfolio is going to face an absolute onslaught of chaotic events. You'll experience bull markets, crushing bear markets, recessions, inflation spikes, political uncertainty, and massive financial crises. Many people completely underestimate this journey, thinking they have to perfectly predict every market movement. But this massive timeline proves that your greatest advantage isn't market prediction at all. It's simply time. Just giving productive businesses time to grow and giving compounding time to work its magic.
The thing is, humans are deeply emotional creatures. We get super greedy when markets rise, and we panic sell when they fall. The fix for this? Automate. When a portion of your paycheck routes directly into your investments, you don't even need to wake up feeling motivated to invest. You completely remove the emotional burden of making a new, fear-driven decision every single month. At the end of the day, systems are infinitely more reliable than motivation.
Now, what's really interesting is how easily people completely damage their financial houses. A solid blueprint means absolutely nothing if you take a sledgehammer to it, right? You have to avoid these completely avoidable catastrophic mistakes. Chasing hot stocks, panic selling during crashes, not having an emergency fund, ignoring taxes and fees, taking on excessive short-term risk, constantly changing your strategies, and falling for that classic get-rich-quick mindset.
You know, the financial industry really wants you to think this is all incredibly complicated, that it requires daily trading and expensive expert intervention. But when you really break down the sequence, true, successful, long-term wealth creation is actually surprisingly simple. You earn, you save, you invest, you diversify, you control your costs, you avoid catastrophic mistakes, and then you just repeat that process for decades. It's boring, yes, but it is highly effective and entirely within your control.
So I'm going to leave you with this core question to consider for your own blueprint. Are you gambling your future on being some Wall Street genius who can perfectly time the market? Or are you ready to finally build a disciplined system you can trust for decades? The greatest wealth-building strategy in the world isn't about predicting the future. It's about creating a solid plan and having the unwavering discipline to follow it.